This is ShadowQuant, Crypto Edition, brought to you by AresLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Tuesday, July 28, 2026, and this is the After Hours session. Now, let's get into it. The Fear and Greed Index has plunged to 14 out of 100, locking the crypto market into a state of extreme fear. We are watching total market capitalization contract to $2.267 trillion as Bitcoin hovers at $63,780, struggling to hold the line against a backdrop of geopolitical shockwaves and vanishing institutional leverage. Before we dive into the charts, let's look at what is scheduled to move the needle in the coming 48 hours. First, we are monitoring the filing details for PayPay's $1.1 billion Nasdaq IPO. As the majority owner of Binance Japan, any volatility in the equity markets regarding this listing will have direct correlation effects on the BNB ecosystem. Second, we are watching for follow-up reporting on the 700% spike in Iranian crypto outflows following U.S.-Israeli airstrikes. If those outflows persist, we expect continued pressure on high-risk altcoins. Finally, traders should brace for potential FOMC-related positioning shifts, as the Federal Reserve's implicit restrictive stance keeps a lid on risk asset valuations. The market snapshot tells a story of defensive rotation. Bitcoin leads at $63,780, down 1.40%, while Ethereum sits at $1,911.46, down 1.10%. Meanwhile, high-beta assets like Solana are trailing at $73.43, down 2.20%, and NEAR is plunging 4.70%. The VIX is quiet at 18.58, but crypto fear is at crisis levels. Let's bring in Pulse to unpack the psychology behind this split.
It is a textbook divergence. You have the SIBO VIX sitting at a manageable 18.58, suggesting traditional finance is complacent, while our crypto fear and greed index is crushed at 14. That gap means retail anxiety is completely detached from institutional hedging needs. The 7-day trend line for the fear index is at 12.0, showing a slow, creeping stabilization. But we aren't out of the woods yet. We are moving from pure panic into numbness, which often precedes a volatile bottom rather than a smooth recovery.
That transition from panic to numbness is critical. CIPHER, let's look at the flows driving this. Bitcoin futures demand has fallen to 2024 lows. Is this a liquidation cascade or something else?
It is voluntary deleveraging. Institutional players are pulling back, not because they were forced out, but because they are choosing not to engage right now. This structural disengagement from leveraged speculation removes the speculative cushion that usually supports spot prices. Simultaneously, we are seeing a 700% spike in Iranian crypto outflows. This isn't random retail selling. This is sanctioned entities liquidating positions rapidly due to geopolitical risk. They are fleeing into liquid hubs like Bitcoin and USDT, which explains why Bitcoin dominance is holding at 56.40%, while smaller caps bleed.
So we have institutions stepping aside and geopolitical actors exiting. What happens to the altcoin basket when both forces withdraw liquidity? Grid, walk us through the technical damage.
The chart structure is screaming defensive consolidation. Bitcoin is holding the 63,780 level, which acts as the last stand for the current consolidation channel. But look at the losers. NEAR has broken its short-term uptrend, dropping 4.70%, and ADAUSD is down 3.2%. These are clear visual confirmations that speculative premium is being violently expelled. The volume is stagnant at $64.69 billion, which means any bounce will face minimal friction but also lacks the fuel for sustainability. We are looking at a slow grind sideways or lower for high-beta assets.
I have to challenge that consolidation framing. At 14 on the fear index with futures demand at historic lows, this is a liquidity trap. The market is calling it a flight to quality, but it is really just forced deleveraging. You have Solana down 2.2% and nearly cut in half percentage-wise compared to Bitcoin's drop. This is not healthy rotation. It is a void of buy-side depth. When liquidity evaporates this fast, slippage events become the primary risk, especially on pairs with thinner order books.
Slippage is a real danger here. Let's zoom in on Bitcoin specifically. Grid, you mentioned support at 63,780. What does the structure look like if that breaks?
If 63,780 gives way, we are looking at a test of deeper structural support, but the immediate picture is one of integrity. Bitcoin is maintaining the 56.40% dominance rate. This is the key metric. Capital is actively flowing out of alts and back into the base layer. The price action at 63,780 is not just a number, it is the anchor preventing a freefall. The relative strength of the entire market is being judged against this single data point.
And that anchor is getting lighter. The fact that Bitcoin futures demand is at 2024 lows means there are very few committed long positions to absorb any additional sell pressure. The Iranian outflows are adding exogenous shock, but the internal structure is hollow. We are relying on passive holders, not active buyers. That makes the 63,780 level fragile.
Let's pivot to Ethereum. It is down only 1.10%, outperforming Solana's 2.2% drop. Is this genuine strength or just slower bleeding?
On the Ethereum/Bitcoin pair, we are seeing a visible bullish divergence. Ethereum is losing ground much slower than the broader altcoin basket. This suggests underlying buyer interest in the smart contract layer despite the extreme fear regime. It is not climbing, it is resisting gravity. But technically this divergence is the strongest signal we have of a potential bottoming process in such a hostile liquidity environment.
I disagree with the bullish divergence label. In an environment where total volume is stagnant and dominance is expanding, relative strength is just a symptom of weaker assets bleeding out faster. Ethereum is not accumulating. It is just avoiding the liquidation wicks that are taking out higher beta chains. Calling this strength ignores the broader context that all non-Bitcoin assets are effectively being deleveraged.
I agree with SPECTER on the sentiment front. The crowd is fleeing risk. We are seeing a massive shift in social tone toward capital preservation. The 700% spike in Iranian outflows has dominated the noise floor. Retail traders are prioritizing survival over opportunity. The fact that Ethereum is only down 1.1% is comforting, but it doesn't mean people are buying the dip yet. They are just refusing to sell it.
Moving to the outliers. Uniswap is up 3.2% to $3.88, while Polkadot is down 3.30%. Apex, is this a rotation into quality or a liquidity trap?
It is a liquidity trap, and here is why. Grid pointed out the bullish divergence in Ethereum, and CIPHER highlighted the institutional retreat from futures. When you combine those, the green candles in Uniswap and Cardano become symptoms of scarcity, not strength. Capital is funneling into these pockets only because the alternative, near Polkadot apt, is collapsing. This is not genuine inflow into decentralized finance or interoperability narratives. It is a defensive shuffle. Until Bitcoin futures open interest stabilizes, these gains are illusory.
CIPHER, do you see any actual inflow into Uniswap, or is it purely relative outperformance?
It looks like pure relative outperformance. We are seeing users rotate into non-custodial safety protocols, which benefits Uniswap, but the volume profile doesn't show aggressive accumulation. It shows cautious holding. The 3.2% gain is happening in a sea of red, which usually indicates isolation rather than adoption. I am watching the BNB ecosystem closely, though, with the Pay IPO filing. Any negative reaction in the Nasdaq tech sector could trigger correlated volatility in BNB. If that happens, it will drag the entire exchange-linked sector down, including Uniswap.
Let's touch on the geopolitical angle. Cointelegraph reports Iranian crypto outflows spiked 700% after US-Israeli airstrikes. SPECTER, how does this manifest in the order book?
It manifests as sudden, large volume sells on exchanges with weaker KYC controls. This is not algorithmic trading. This is human capital flight. It creates immediate sell-side pressure. For the broader market, this reinforces the extreme fear rating. It reminds every trader that crypto is still susceptible to black swan geopolitical events. This is why Bitcoin is holding up better. It is the safest haven available. But for anyone holding risky altcoins, this is a reminder that liquidity can vanish overnight.
Finally, let's look at the legislative landscape. The U.S. Senate housing bill includes a CBDC ban. Pulse, does this move the needle in a market this scared?
Not immediately. The market is too focused on the liquidity crunch and the fear index at 14. A CBDC ban is a structural, long-term bullish factor for decentralization. But right now, retail sentiment is dominated by the immediate fear of losing capital. People aren't thinking about digital dollars. They are thinking about stopping the bleeding. The headline is there, but it is being ignored by a market in trauma mode.
So we have a market caught between geopolitical shocks, falling institutional leverage, and structural policy shifts. Apex, give us the strategic synthesis. Where is the risk?
The core risk is that the flight to quality is masking a broader liquidity crisis. Grid identified the support at 63,780 for Bitcoin, and CIPHER confirmed that futures demand is at 2024 lows. This combination means there is no buffer. Any new negative catalyst, whether it is the pay IPO reacting poorly to Nasdaq conditions or more news from the Middle East, could cause a sharp repricing. The outperformance in Uniswap and Cardano is not a shield. It is a mirage created by the collapse of other sectors. Reduce exposure to assets outside the top 2 by market cap until we see a return of aggressive funding rates.
Let's recap the key takeaways from this session. First, Bitcoin is testing critical support at $63,780, with dominance holding at 56.40%, but this support is thin due to record-low futures demand. Second, the Fear and Greed Index at 14 confirms extreme fear, driven by geopolitical outflows and institutional caution, creating a decoupling from the calmer equity VIX. Third, apparent strength in assets like Uniswap and Ethereum is largely relative outperformance amidst a broader liquidity vacuum, not a sign of renewed bullish conviction. As we close out the Tokyo session, keep an eye on the pay IPO filing details and any updates on the Iranian outflow data. We will see if this defensive posture holds or if the liquidity trap tightens further. Thank you for listening to ShadowQuant Crypto Edition. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Crypto Edition. Stay tuned for the Tokyo session where we will see how these calls play out. Until then, trade safe.